It's often said that the reason behind Bitcoin's dramatic price surges is closely linked to its halving events. Historically, we've seen a striking consistency in its performance around these times, with prices skyrocketing significantly. In theory, the Bitcoin halving expected to occur in late April should prompt a similar explosive growth, sending its value soaring sky high. However, this time is different due to fundamental changes in the market's underlying conditions and the supply-demand equation. How high Bitcoin will rise and whether we'll witness a general upswing in the altcoin market have quickly become the most heatedly debated topics of late. Next up, I'll be spilling the secrets behind the halving phenomenon and introducing a suite of analytical tools designed to predict Bitcoin's price fluctuations. Be sure to hit that subscribe button and stick with me till the end. It could be a game changer for your finances this year. Imagine Bitcoin halving as working in a gold mine. The mine owner signs a contract with you upfront, promising 50 pieces of gold as a bonus for every cart of gold you dig up at the start. However, since there's a finite amount of gold in the mine, the rewards can't stay this generous forever. After a certain number of carts are dug up, your bonus is cut in half. So, after some time, you'd only get 25 pieces for every cart. Then after some more time and more carts, it drops to 12.5 pieces and so on. The principle behind Bitcoin halving is much the same, except what's being mined are blocks, and the rewards are in Bitcoin. That's why Bitcoin is often referred to as digital gold, and those who mine blocks are known as miners. As the mine's gold becomes scarcer, mining isn't as simple as it used to be and requires specific equipment. Moreover, with the reward decreasing over time, miners are compelled to sell some of their earnings to make a living, leading to price fluctuations. This introduces the basic principle of supply and demand. Bitcoin has only undergone 3 halving events so far. Before each of these halvings, there was a price increase of 2 to 3 times. Following the halvings, the price surges were even more dramatic. After the first halving on November 26, 2012, the price increased by 98 times. After the second halving in 2016, the increase was 31 times, and after the third halving in 2020, the increase was 7 times. Currently, before the fourth halving, we've already seen a 2 to 3 times increase. If this pattern holds, there's significant upward potential after the halving. Nowadays, a 10% fluctuation in price can mean a change of $6,000 to $7,000. The diminishing multiplier effect seen after each halving correlates with the increasing amount of mined Bitcoin. With around 90% of Bitcoin already mined, the absolute quantity of the remaining 10% supply side is decreasing from 50 to 25, then to 12.5 and so on with each halving. However, the impact of each halving on the supply is also diminishing. Therefore, the potential for price increase this year depends on various factors beyond just the halving. Reflecting on the past, the first Bitcoin halving coincided with the European debt crisis and the Cyprus debt crisis. This marked Bitcoin's debut into mainstream visibility, leading to a price surge. The second halving in 2016 occurred amidst the ICO craze, attracting significant wealth into the crypto market. The third, in 2020, happened during the COVID-19 pandemic, when massive funds worldwide turned to Bitcoin as a hedge against the crisis. These factors, combined with the reduced supply due to halving, shaped the trends observed during these periods. Throughout these halving events, the influx of funds into Bitcoin was more likely from investors outside the traditional finance sphere. Such investments were not particularly loyal or enduring and were time-sensitive, differing fundamentally from the dynamics at play with the latest halving. The approval of Bitcoin ETFs marked a pivotal moment that bridged Bitcoin's niche circle with the wider world, allowing substantial capital to directly influence Bitcoin's trajectory. Funds from private investors, institutions, and even governments with an active interest could now continuously and directly impact the market. This shift represents a fundamental change, where actively engaged capital, rather than passive or speculative investments, plays a leading role in the cryptocurrency's valuation and stability. If similar events occur again, such as extensive printing of money, interest rate cuts, or significant changes in the Treasury General Account, TGA, we'll see a very clear response from the crypto market to the influx of excess capital. Traditional professional traders and institutions are likely to enter the scene. These long-term traders, with their high loyalty and strong capabilities, are prepared to cultivate specific markets over time. Therefore, as the impact of halving on supply diminishes, we should pay more attention to liquidity data on the demand side in the future. Identifying factors that can actively bring substantial capital inflows and outflows to the market will be key to understanding market fluctuations moving forward. It's the large capital that can drive significant price volatility. We should regularly keep an eye on 3 key areas: the U.S. unemployment rate, the scale of the Federal Reserve's balance sheet, and the TGA balance. These are directly linked to significant amounts of money that affect people's wallets. Additionally, the flow of Bitcoin ETFs is crucial, featuring detailed data on the daily capital flow movements of major institutions like Grayscale, Fidelity, and BlackRock. While more detailed insights can be gained from these sources, monitoring the ETF flow data alone is usually sufficient. Upcoming significant events also warrant attention, such as the progress of the Ethereum ETF in May and potential interest rate cuts by the Federal Reserve. These developments are almost certain to happen. If interest rates aren't cut, the next interest payment could reach $1.6 trillion, which would be excessively high. A cut in interest rates would lead to a large influx of capital into the market. By focusing on these 5 categories, we can essentially grasp the market's trend and direction. However, to pinpoint the exact moments of significant capital inflows and outflows, it's crucial to monitor exchanges and professional on-chain data platforms. Exchanges act as gateways for capital transactions. When there's a large-scale intent to sell, aside from private deals, most of the activity flows through exchanges. Therefore, we should regularly check the overall exchange balance sheet and the changes in the number of Bitcoin addresses holding more than one Bitcoin. Observing the 24-hour trading volume, open interest, price spreads, and market depth can also provide first-hand liquidity information. Continuing, we can turn our attention to the charts. Regardless of how or why this bull market started, the volume at the bottom was exceptionally high, indicating that a vast amount of capital was already absorbing shares before these significant events took place, suggesting a demand that was as large as necessary. This smart money must have known something in advance to some extent. According to the theory of accumulation and distribution, the shares absorbed here are eventually intended for sale. This distribution occurs either during market fluctuations or during a rally. The best way to distribute is certainly at a high point when the market is frenzied and capital is eagerly buying in. Observing the data and charts, there are currently no signs of significant distribution yet. So, the bull market seems unstoppable and enduring. However, whether a raging bull market will arrive as quickly as some expect remains to be seen. Looking back at previous Bitcoin halvings, there's typically a period of consolidation and adjustment for a month or two before a significant breakout occurs. Currently, the price has formed a triangular convergence structure near the previous highs, which is a normal high-level fluctuation. This is because there's a lot of capital trading near the previous highs, some taking profits, some calculating odds for new positions, and some being liquidated. For instance, Grayscale's recent continuous selling may be significantly related to being trapped for too long previously. In addition, the price is also fluctuating around the 4-hour Vegas tunnel, serving as a good reference area. If, after continuous fluctuation, the price significantly drops below the converging structure and the 4-hour Vegas tunnel to touch the daily tunnel, the $50,000 area is where many are likely to buy in spot and with low leverage. If prices test this psychological defense, though the probability is small, have we considered strategies in advance? What should we do now, and what actions should we take if there really is a significant drop? Or, if the price breaks above the 4-hour tunnel and the converging structure in a significant move, should we chase the breakout? Indeed, we should prepare for both scenarios now. Trading is all about responding to moves as they happen. There are 2 risk factors to keep in mind. The first risk is the common occurrence of sharp drops during a bull market. Many, eager not to miss out and seeking faster gains, resort to high leverage without a clear plan to take profits, often leading to poor outcomes. This is evidenced by increasing liquidation volumes following significant market movements. Particularly in Bitcoin, after it starts creating wealth effects, significant liquidations can occur near major milestone levels, such as a $10,000 pullback after setting new highs, which once resulted in over 200,000 people being liquidated. Thus, if Bitcoin indeed aims for the $100,000 mark in May or June amidst various positive developments, it's crucial to avoid high leverage at such symbolic levels. The second risk arises from traders' behaviors during an uptrend. Bitcoin, being the leading cryptocurrency, initially attracts most of the capital inflow. Once Bitcoin's price stabilizes after a significant rise, traders who have profited might start looking for some brilliant new opportunities. Many tend to withdraw funds from Bitcoin and invest them in altcoins to capitalize on market rotations, which represents a significant risk. This strategy, while tempting, often leads to increased volatility and risk, especially for those not experienced with the market's intricacies. Predicting which cryptocurrencies will rise or fall is challenging, and attempting to trade back and forth often results in gains on neither end. Bitcoin is seen as the most reliable choice among cryptocurrencies, and the long-term investment returns of most altcoins do not compare favorably with Bitcoin's. However, many investors still gravitate towards altcoins, believing that while Bitcoin may not multiply by tens or hundreds again, altcoins could. When investing in altcoins, having a strategy is crucial, as the decision-making window for altcoins is typically short. Often, by the time an opportunity is identified, the asset has already experienced a significant rally and is about to undergo a major correction. Success in altcoin investing either requires early positioning or very decisive entry points. Furthermore, it's important to choose situations where profits can almost be made blindly. This approach necessitates a keen understanding of market trends and the ability to act swiftly and confidently. For instance, the recent episode when Bitcoin surged from just over $50,000 to $70,000, altcoin rotation became strikingly evident. At such times, focusing on the current hot coins, especially those witnessing unusually high capital inflows, and decisively buying in at the breakout could lead to gains of about 20%, or at least 10% within a day. This is the benefit of a market-wide uptrend. The majority can profit simply by not being overly greedy, with hardly any technical skills involved. All it takes is observing the energy trends on 1-hour and 4-hour charts and checking for any abnormal capital inflows. Making money in such an environment is remarkably straightforward. For those looking to place early bets on altcoins, a bit of investment research is necessary. You need to be clued into the current buzz, understanding the trending topics and themes ripe for speculation, identifying the leaders in these sectors, and then allocating a small portion of your capital to a portfolio of 5 to 10 cryptocurrencies could be a savvy move. If even just 2 or 3 of these selections take off, the portfolio is likely to see overall gains. All right, don't forget to hit the subscribe button to stay updated with more profitable trading contents. I wish you a good morning, good afternoon, and good evening. Goodbye.